Welcome to the Online Great Books podcast, brought to you by OnlineGreatBooks.com, where we talk about the good life, the great books, great conversation, and great ideas. I'm Scott Hambrick.
And I'm Karl Shute.
Today on the Online Great Books podcast, we're going to talk about Benjamin Graham's phone book of a text, The Intelligent Investor. It's a giant book.
Today's the day I do the sigh. I am completely a novice at any of this stuff, but I made it through the book. A lot of little gems to take out of it. It's how to invest, but what it is not is how to speculate.
Grandmother would say that's the mainest thing in the book.
The mainest thing. So the difference between an investor, well, he's probably got a definition somewhere in here, but an investor is somebody who is attempting to make steady gains. A speculator is somebody who's trying to beat the market.
I think an investor is somebody who's trying to purchase an asset that they think will that will produce a predictable yield based on the value of the asset at the time they paid for it, the price that they paid for it. The speculator's betting on the come, we'd say. Buy those tech stocks. Which one? Oh, that sector, it's headed up, up, up. A speculator's criteria for purchasing an asset would be much different than an investor's.
Right. So when we think about what a stock is, it was very good for me to read this. And this is the sort of things I should have paid attention to in 1990, instead of 2020. But in my defense, I didn't make a whole lot of money. So, if you don't make any money, this is not for you. You have to get your budget balanced first. You have to actually have some money in which to make purchases. But the typical sense of a stock is like, I got this hot stock tip. It's going to go up next week. Buy now and you can make money later. And so all you care about is which direction the stock goes. You don't actually care what it is. You might not even know what they make.
Yep. Let's back up for just a second.
Sure.
Why the heck are we reading this one?
Well, because you told me to.
Oh. Okay.
Because it's a classic in the field. I don't know. You know more about it than I do. Lots of people, to the degree that anybody has had any success over the long term in the stock market, it's using something like Graham. Isn't that correct?
Probably. Yeah. Benjamin Graham wrote this thing in like 48, 49. He was an instructor at the Columbia Business School. Warren Buffett famously follows his methods, or he claims he does. We can talk about Buffett here in a little bit as well. And Buffett supposedly read this book when he was 19. And Buffett was in the world of investments pretty quickly thereafter. Graham outlines what people now typically call value investing, where you purchase stocks based on the value of the company, the pro rata value of the company, as opposed to, the speculation you're talking about. There might be growth investing, right? You might say medical prostheses and appliances, that market is going to grow because of the aging baby boomer population is going to need knee and hip replacements, and we think that's a growth field, and we're going to buy into that segment of the market, and we're going to ride that wave of growth. That'd be one method. Another method might just be, throwing a dart at the Wall Street Journal page with the stocks on there. Speculating on tech stocks in 1998, 1999 was probably, growth investing, but people weren't analyzing these stocks as standalone companies and thinking of them as assets they were buying little pro rata pieces of, and that they wanted to pay fair and decent prices for. And Benjamin Graham sets forth a whole bunch of rules and methods for determining just what really is a darn stock worth and what should you be willing to pay for one. So, if somebody came to Graham, who died in the 70s, and said, "Hey, this Amazon, that's a great stock," well, he would say, "Show your work. Tell me exactly why. What makes it a good stock? What am I buying for my stock purchase money?" He convinces over 623 pages to show us how to do that.
So you can always you can go to the end and see what he's after. So this, for my book, it's page 523. Investment is most intelligent when it's most businesslike. It is amazing to see how many capable businessmen try to operate in Wall Street with complete disregard of all the sound principles through which they have gained success in their own undertaking. Yet every corporate security may best be viewed in the first instance as an ownership interest in or claim against a specific business enterprise. So when you buy stocks, if you buy stocks, you're not buying a piece of paper that might go up next week. You're buying an ownership stake in an actual business that makes an actual product and sells it. You're becoming an owner.
Online Great Books is an LLC. It's a limited liability company. But I had a business I sold not too long ago, which was an S Corp. Most big companies are C-type corporations, but this one was an S Corp. But it means it had shares. And so I owned all 100 shares of my small business. There were 100 shares, and I had a stock certificate that said 100 shares. And we had a board meeting minutes book that showed that we had issued 100 shares, and then we could track them back and say I had title and ownership of all of those. And we had, when I sold the business, we had 3 or 4 trucks, we had a couple forklifts, and we had computers and servers and software, and I think we even had a typewriter, and all that stuff was worth something, right? You could have an auction and sell those things. And then we had customer contracts that were obligations for the customers to pay us in the future. We had some inventory, and all that stuff is worth money. So you could total up what all that stuff we had was worth, subtract any liabilities that we may have had, and say, well, that's what the company's worth. Divide that by 100, and in the best world, that's what each of those shares would be worth. But Graham says that the stock market is a pendulum that swings between optimism and pessimism. Mr. Market is a weird person. And when the stock market is optimistic, you should be pessimistic. And when the stock market's pessimistic, you should be optimistic. Because when the stock market is pessimistic, it tends to undervalue the shares relative to what all the underlying stuff is worth. So in my example of my 100 shares of my business, let's say they're all worth $100,000 a piece. Well, when the market would be, when I say worth that, I mean, if I had an auction and sold everything that we had, maybe we could have got $100,000 of share, let's say. Well, when the stock market's pessimistic, it wouldn't give $100,000 for one of those shares. It might give $85,000 for one of those shares. So in which case, if you went in there for 85, you're getting 100 for every 85 you buy. You're buying the assets of that business. You're buying the value of that business for 85 cents on the dollar. And that's where Graham wants to be. When the stock market's afraid, he wants you to not be afraid. And when the stock market's not afraid, he wants you to be very afraid. And he has objective criteria for showing you why you should be afraid and why you shouldn't be, and when that happens, what that looks like.
I think it's in the intro. Buffett says, the intelligent investor is a realist who sells to optimists and buys from pessimists.
Yeah, it's clever.
Yeah, so what you're buying is the value of the company. You're hoping to make money, but there's different ways to make money. You could make money from dividends, or you could make money from planning to resell the stock certificate, resell the shares
for more than you paid for them.
From more than you paid for them,
or both.
But I'm always thinking of that Eddie Murphy film, Trading Places. And it's commodities. It's not quite the stock market. You're hoping to corner the market on orange juice and make a big turn. And you're hoping to get that big movement in your stock, and then you're done, and then you don't have to do anything else, and you're a millionaire.
Yeah.
Does it work like that?
Every now and then it does. There's some people that hit a ball out of the park, and we get to read those stories about those people, and they become famous, and everybody else chases them. But by and large, everybody gets the average return of the market, right?
Mm-hmm.
The market has an average return. The market, whatever that is.
Mm-hmm.
You're going to tend towards the average. So for every person that hits one out of the park, somebody else is going to get wrecked. And chances are you're going to be right in the middle. But Graham says that your chances of doing better than that, doing better than being in the middle, lie in value investing, properly determining the intrinsic value of a share of stock, and paying a price that gives you a margin of safety when you buy that, because the value of the stock is the future value of that stock as a function of the price you paid for it.
Okay.
Karl hates this stuff, I think.
No, if you pay too much, I didn't quite figure out the math on the margin of safety, but if Scottco is selling at $100 a share and it's worth $100 a share, and if I buy it for $100 a share, what's my margin of safety?
Yeah, there's not one. And margin of safety is subjective or ephemeral a little bit here. Let me tell a story. There was a time pre-iPhone when I was looking at stocks by this Graham method, and I looked at Apple, and Apple had their campus in Cupertino, California. That's worth money. You could sell that at an auction. If the thing went belly up, they could have sold that at an auction and gotten something for it. So my share, if I buy a share of Apple, I would have been entitled to my pro rata piece of the sale of the Cupertino campus. And then they had steel case desks and furniture and fixtures, it says on the balance sheet, furniture and fixture, and some other sorts of assets. And one of them was cash, of course. The stock was selling for less than the pro rata piece of cash they had in the bank. Well, I bought a little bit. What's the margin of safety on a stock? Like if you pay $100 for a share of a company, and your pro rata share of their cash alone is $103, plus they have some real estate holdings and other assets, including intangible assets like the intellectual property in the Macintosh computer, the brand, and so on. What's the margin of safety on that? I don't know what the percentage rate of the margin of safety is, but it's significant.
So the value is 100. Let's say the value of the cash is 103.
It was literally something like that. It was like 3 points higher.
Let's say that the fixtures and the campus and everything's another $22 per share. So that the value of everything's 125. That means that stock can drop $25 per share. Am I thinking of it right?
Well, you're buying $125 worth of goodies for $100. So you're already in the green. And the chances are, it's more about the upside, really. Chances are you're going to get a 25% upside because the market is somewhat efficient. And chances are you're going to go and get that $25 in form of capital appreciation. The darn thing could still go to zero and make you lose all 100. The campus could burn down. They didn't pay their insurance. Somebody absconds with the cash, or they start a video game console program or something and they lose it all. You can still go to zero, but the chances that you'll go up are extraordinarily higher because you bought at a discount. It was on sale as far as you could tell. We've been talking about what the assets are worth, but these companies also have liabilities. They owe money. What's the Cupertino campus worth to the shareholder if it's mortgaged to the complete gills? Nothing. You've got to look for those liabilities. And Graham tells us how to do that. A lot of those liabilities are just straight up debt, but some of them are pending lawsuits too. And where do you put that on the financial statement? So he tells us which rocks to flip over to look for the nasties, and determine what those good values are.
Okay, let me ask a hypothetical here. As somebody who knows nothing about this, I'm thinking, do I really care what the assets of the company are? In other words, if the stock market is a bunch of mostly irrational people following trends, okay, people buy stocks not because of the intrinsic value of the company. They might not even know. They might not even know the price per earnings ratio. Mm-hmm. They might not know any of that. They just see that it's going up and they buy it. Do the underlying concrete value of it, does it even matter?
Well,
like tulips, do I care that tulips don't have much value if everyone's paying a lot of money for tulips?
Not until you do care, right? Like if you're swapping those tulips and you keep trading, you keep making money on those tulips, it's great till it isn't, right? Buffett says, when the tide goes out, everybody sees you swimming naked. And you don't want to be that guy when the tide goes out, and it tends to go out. COVID could make the tide go out. You could be buying shares in, I don't know, Airbnb or something, and their market completely dissolves because no one can travel. And at that point, yeah, you really care what Airbnb's assets are. And I don't know, I haven't looked at the financials for that, but they don't own hotels, you know? They've got some desks and stuff, and there's some intellectual property, and maybe they have some patents. But unless they've got a bunch of cash, they don't have a lot of assets. And so if you pay more than the book value for Airbnb and the tide goes out, travel stops. Eventually, Mr. Market, as irrational as he can be, will get hip to the fact, because people are treat their money pretty dearly and will quit putting money in there. And that's when you get burned.
So this is a Great Books podcast, so I guess we're implicitly saying that this is a book that's at least pretty good.
It's pretty good. Makes you think, at least.
Yeah. And so one of the things it makes you think about is the thinginess of companies.
Yes.
I know you were telling me off the air, you thought that this was kind of a metaphysics book.
Yeah.
That it does matter what a company has. It does matter what a company owns. And that if you look for companies that have good values and good fundamentals, you'll do better than you would otherwise. You might do a bit better than the market.
Yes. Well, we'll come back to doing better than the market here in a little bit. But I do think it's a book about Graham's metaphysics of coperatehood. You know, he sees these shares as real live pro rata chunks of these businesses, and he sees you as a shareholder as a silent partner in that business. And I agree. Now, a day trader doesn't see him that way, does he? The day trader's got he's got 5 computer monitors, and he's looking at the Shanghai, stock exchange in the early morning hours, and he's just trading these things based on trends and based on graphs of, you can go read Investor Business Daily and look at their chart investment method. And he's just trying to ride these trends and find these inflection points. He's not buying companies.
My dad had a few of those books in the 80s, I think, which would you'd try to time the market. It'd be charts. When it looks like this, for the most part, it's going to go the other way.
IBM is going to find support at this price level. And once they break through that price level, they historically will have an 8% leap,
But why?
But what's IBM worth? What do they have? Do they have customers? Prove it.
Yeah, so they're treating stocks as monads that act in the way they're going to act regardless of underlying business conditions. If you say IBM's at this point of inflection on the graph and therefore it's going to go another way, but you don't care that they've just come out with the PC Junior, which is a pile of crap, you're treating it as if it's not a real thing.
Right. And people will call them instruments. Where they're not really thinking about it as, fractional ownership in a large company. I've bought a few small companies, but Graham's method is plain and simple and clear when anybody but fools would buy a small company. My father-in-law bought a landscaping company last year, and he said, "Hey, would you look at these financials with me?" I said, "Sure, man, I'd be glad to." And he brought him over, and the guy had this much equipment. And we looked up the blue book value of all these different pieces of equipment he had, and we totaled that up. We looked at the customer list and estimated what the revenue would be off of that customer list for the next year or so. We looked at his earnings from the last couple of years. We said, are these earnings right? Did he sneak anything? Is there any kooky bookkeeping here? Could the earnings have been higher if he wasn't paying for his wife's car out of the business? And we figured out how much money is it really making? Does it have any debt that we would be buying? And what's the equipment worth? And it was a small business. It was pretty easy to get to a good number there and make a deal on it. My father-in-law bought the business. But something about making the stock certificate and the fact that you buy stock certificates from other individuals on exchanges instead of directly from the company kind of breaks that metaphysical link from, where you understand the thinginess of the thing you're buying. A stock certificate is like the title to your automobile or a deed to a house. It's a title to that little bitty piece of that apple pie in Cupertino or that IBM pie. That's what you're getting. And he spends, several hundred pages showing you how to best determine what that piece of that pie is worth and what some of the dangers might be that you should look for. And then also how to put together a portfolio. Are you going to be a defensive investor? Are you going to be an enterprising or active, aggressive investor and meet your financial goals?
Mm-hmm.
I was doing an orientation at Online Great Books last night for our new members. Thanks, guys. It was fun. And somebody asked, well, why don't you put out a list of all the books you're going to be reading on the podcast so we could read along with you? I said, well, you don't understand the game because we don't know either. But I said, we're going to do this one. And one of the guys, I guess he's in this biz, and he says, that book is irrelevant. The first 3 chapters is all you need. Forget about it. The world's changed so much. I don't know that he's wrong, Karl.
Tell me how.
Well, the first time I read this book was probably 20 years ago. It might have been 25 years ago. And at that time, there may have been day tech. There may have been a few internet brokerages around. I think I was on Daytech at the time. Most people got their stock pricing information from their daily newspaper. It was difficult to get financials. You had to wait for a quarterly filing or get the annual report. So pricing probably wasn't as efficient, right? You'd have a better chance of finding something like the Apple deal where they were trading for less than their cash. It's a lot harder to find those opportunities. You can imagine when Graham was doing this, particularly during the Great Depression, how many companies were undervalued during the Great Depression? Lots.
Mm-hmm.
By any measure you can think of, lots of undervalued stocks. Consumer sentiment was poor. Everybody was pessimistic. Information was harder to get. Probably lots of undervalued stocks. There are, by any measure, less undervalued stocks now because of that. The market, in that respect, is probably more efficient. Information is baked into the pricing more quickly and efficiently now, I think, than it was in the 40s. And this is probably the worst thing. And I was going over my notes and reading through this thing again and was a little squeezy the whole time because right now, our Federal Reserve Bank is buying corporate bond funds. They're buying corporate debt. So they're underwriting liabilities for companies right now. And they have intimated that they're going to start buying index funds and actually buying stocks. They haven't done that yet, but they have intimated that they might if they needed to. In the last 10 years, the largest stock traded in the United States has grown to the point that it is bigger than the top 5 stocks that were traded 10 years ago. Apple is almost worth $2 trillion right now. Apple is worth almost more than the rest of the Russell 2000, which is most of the other stocks in the country. There is a game being played that is not an efficient market game, and I don't claim to know what that is, but it makes it, for me, when I look at the stock market, you have 2 choices, I think. Vote with the Fed or against it. And the value investing is actually probably voting against it. You could buy an unsexy company that specializes in selling lumber, let's say, harvesting and selling lumber wholesale, for example, maybe, and say, well, golly, it's got these timber leases for these 100-year timber leases that are worth an enormous amount of money that they secured at a very low price. They have almost no debt. They haven't missed a dividend payment in 20 years. Their dividends have grown 1%, 2%, 3% every single year for 20 years. I'm paying pennies on the dollar. That's a good value investment. But is the money going to flock to that company over the next 1, 2, 5, 10, 15, 20 years and give you that capital appreciation? I don't know.
Yeah, nobody knows, I think.
But over the last 10 years, it's all flocked to that top 5. Facebook, Apple, Amazon, Microsoft, and Google. That's 6, maybe. I don't know, but it's mostly flocked to those. And that has left most of the rest of the market languishing. You might be saying to yourself, well, that means that there are values there. Could be.
Yeah, but if you pay a high price for Apple, okay, so if you do, I want to read a paragraph. This is, I think, on page 1 or page 2, talking about the charts and the largely mechanical means of determining the right moments to buy and sell. The one principle that applies to nearly all those so-called technical approaches is that one should buy because a stock on the market has gone up and one should sell because it has declined. This is the exact opposite of sound business sense everywhere else. He says he doesn't know anybody who's beaten the market doing that. He says later, you ought to buy your stocks like you buy your groceries, not like you buy your perfume. which I thought was funny.
That's great.
Because perfume, you have to buy the expensive stuff because you're buying that you wear Chanel No. 9 or whatever. If in a time of uncertainty, which is where we are, I guess we're always in a time of uncertainty, but you don't know what the Fed's going to do. If they start buying stocks, it would seem to me, who don't know much about this, that this would be a time to buy value because you don't know the future. You don't know what's going to happen to any of these huge money-sucking companies at the top. But the lumber company, they're probably still going to be in the business. You might not make huge gains, but you shouldn't ought to lose very much.
As price discovery is broken by perhaps the Fed getting in there, and even if the Fed doesn't get in there, it seems to be that a lot of the money that they are creating right now, the expansion of the money supply, is going into the stock market and pumping up some prices, but not all. Well, if that continues indefinitely, you might be stuck with your value stock yielding only the dividend for you because the capital appreciation may not happen.
Yeah.
I don't know. I have no idea. So weird.
That's part of the point is even before this sort of intervention, you have no idea. Okay, so the thought that stock markets go up when the Redskins win the Washington football team wins the Super Bowl, or people have all of these ways of trying to predict the market. And for me, his analyses of the market from around 1930 to 1971 or 72 is that you can't really do that, that nobody can really do that. And so if that's the state of things, how do you do well? You want to increase your assets. That's the whole reason for investing, right? Unless you're trying to take over a company or actually do business. If you're a guy like me and you've got some cash finally, you're trying to have it beat inflation, okay?
Yeah. Are you trying to match the market?
Well, matching the market, at least so far, would be better than inflation. And so if I have a little bit of money, I don't want it to lose value. So I see quantitative easing. I see all sorts of money being pumped into the system. I don't want the little money that I have to be worth less.
Sure.
So I want to protect my principal, and I'd like it to grow.
So would you be what do we call these people? A Grahamian? A Benjamite? Defensive investor?
I would be a defensive investor, sure. I don't have the time to be anything else.
Yeah, he's got the defensive and then the aggressive investor. The defensive investor, they aim to minimize their losses and their heartache too. So they want low effort, low annoyance, low fees, and so on. And then an aggressive investor they're willing to spend as much time as it takes to get a slightly better return. Period. The end. Period. So since this book came out, we've had the Bogle, Bogle approach, which says, markets are pretty efficient. And since you're a part of the market, you're going to, over time, capture the average return of the market minus your fees. You have to. The market returns the average. And if you're part of it, statistically, chances are you're going to get the average market return minus your fees and or taxes. So Bogle says, just match the whole market. Just buy the whole darn thing. Buy an index that tracks the entire market activity and do that in the cheapest way you can, and that'll give you your best return. He says, don't try to pick, because the statistics tell us your picking is going to get you the average. Half of you are going to do worse than average, and then more than half of you are going to do worse than average after fees. So he's like, don't be the guy in the bottom quartile. Just buy the S&P 500, buy it over here at Vanguard. Our fees are very, very low. On you go. That's interesting.
Mm-hmm.
Graham ain't that guy. Graham isn't that guy. So that's a different metaphysical outlook too, isn't it? To buy the index fund, to buy the market. Like, what the heck are you doing? I think they're free riders on a game. You've got a bunch of people out here taking risk buying stocks in order that price discovery will work. And then you've got a bunch of people just buying an index fund because they just want to match the average return.
You think it's distorting the market?
I don't know that it's distorting the market, but it's not helping. What would Kant say? If everybody did that, what would happen? It would definitely be distorted.
Yeah. But it's a good point on the fees, right? If it costs you money to put your money in these things, you have to take that into account.
You bet.
If you're going to be a day trader, you have to make money just to stay where you are because there's a fee in doing all this trading.
Yeah. Benjamin Graham's defensive investor is very interested in doing it at a low cost and low annoyance. Me too. He makes pretty good arguments in here in the portfolio management chunk towards the back of the book. I don't know where it is.
Scott has this book memorized.
Yeah, it's back in the back of the book. That maybe you don't care about what the market does. I'll paraphrase. Maybe you don't care what the market does. Like, what do you need? What can you stand? I'm very interested in this idea. If you've got $10,000 to your name, period, and you're 70, how much risk can you take? I'd say 0.
Mm-hmm.
Like if you doubled your money, what would that get you? A few more loaves of bread. So I don't think the risk for somebody that's 70 with $10,000 would mean that they would care about trying to match the market or anything at all. So they need to go buy a CD or something to get their 0.8% or whatever and just cruise it out. What if you get $10,000 and you're 19?
Saddle up.
Get a completely different risk tolerance. They're investing for a different purpose. Wasn't about 10 years ago, I decided I didn't care about beating the market anymore or capturing the return or maximizing it really in any way. I just sit down with my Hewlett-Packard 12C calculator, gold edition, and figured out how much money I thought I would need and tried to figure out when I would die and said, what kind of yield how much do I think I can save each month? And what kind of yield am I going to need to get between now and retirement to meet my goal? And we're pretty stingy over here. We don't spend very much money. And I've saved for a long time, starting when I was about 17, started buying stuff, whether it was businesses or stocks and everything. And I decided that if I could stay ahead of inflation by about 2 points, I'd be able to get out of the game. So I don't care about 8 points.
Mm-hmm.
The stock market, let's say that the stock market averages around 8% a year over the long haul. We'll talk about what the long haul is here in a little bit too. So Graham would give me the blessing on that. He'd say, you know what, you're right. You don't need to take that kind of risk. You've reasonably set some goals here that are attainable at a low cost and at a low risk. You should probably proceed with that. He would say, why would you, if you try to go with Bogle's approach and match the return, you're also going to match the risk. He's like, Hambrick, you don't need that. You're sitting pretty. You don't need that. So don't. Go get your 2-3 points. How hard's that anyway? Go do that. So he would put me in the defensive investor in camp, and I think, and so have I.
Mm-hmm. I thought the comments that he makes about temperament are interesting. That the great danger of getting into this is if you have the wrong temperament. If you are going to chase after the moon and then jump off a bridge when you don't get it. I mean, there was that kid. There's that Robin Hood thing now. There's some kid that killed himself because he got himself some millions of dollars in debt or something. He was 19. Declare bankruptcy. Go on with your life. Whatever. You're 19. You got 60 years probably. But if you don't have the temperament to do this, then do the lowest risk you can and get a little return and sleep easy at night.
He advocates here for balancing your portfolio between stocks, the percentage of your portfolio that you have in stocks or in bonds based on your temperament. He says if you can act as a cold-blooded weigher of the odds, you'll be likely to favor the low 25% stock component at this time. The idea, but anyway, he's talking about a specific economic condition. If you're a little more volatile, maybe you want a different kind of approach. I think that's right.
An investment this is page 18 in my book. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Okay, so reasonable promises of safety of principal and some kind of adequate return. That's what makes you an investor. If you are attempting to buy Hertz stock after it collapsed this year and hopes that somehow it's going to come back, you're a speculator. Unless it's so cheap, but even then, it might go to zero.
It's still speculative because it can't demonstrate the cash flow or its ability to meet its demands and continue to pay its dividends out.
So most of you, I guess, I am defensive. I don't have that much money. I have a bit. I'm doing better these days than I ever have been because of, a couple of things going right. I want it to grow, sure. But I'm not going to spend all day sitting in front of a screen trying to day trade. And there's too much risk in that anyway.
Do you need to?
No.
Yeah.
No, not as long as I'm reasonably employed.
Yeah. And I would argue if you're not reasonably employed, your need to do that would be even less.
Right. Well, I'd need to become reasonably employed.
Yeah.
You need an excess before you're going to even be a defensive investor. If you're living paycheck to paycheck and you're carrying a bunch of credit card debt, and you don't own your house, and you got car payments that you're barely managing, this is not for you.
Well, but you still should read this book, though, Karl, because you should treat yourself as a business, and you should look at everything in front of you that you're going to perhaps use money to handle, I think, with Graham's lens. So let's say you start doing okay. Let's say you're a 29-year-old and you've gotten a promotion or two and you're doing pretty well for the first time in your life. And you're like, man, I got a chance this year to max out my 401k. People are going to hate me for this. They're going to hate me for it. But I've got all this debt, but I can max out that 401k. I think Graham might highly recommend that you pay off the debt and forego the return in the 401k. The investments there's risk involved with them. There's risk involved that, you might lose all the money you put in there. And there's also an opportunity cost that is a risk. Let's say you put money in the 401k and later you need the money for something else because your wife gets cancer.
Mm-hmm.
You're going to have to pay, well, not that example, but you might have an opportunity to buy a business or something. Maybe your boss offers you to let you buy into the business you work for. Well, now you can't because your cash is tied up. There's an opportunity cost too. So there are risks involved with being in the investments. What's the risk in paying off your stinking debt? Well, there's an opportunity cost there. You pay off your debt, and now you don't have the cash. So you blow up your transmission, and maybe you spend it all your cash on paying off your credit card. Well, you still got the credit card, right? You can still go right back there if you needed to.
Mm-hmm.
But that's an almost risk-free return on the money that you would be spending to retire the debt. So, his approach teaches us how to evaluate any way of deploying your cash versus any other given way of deploying the cash. So I think even if you're broke, I think you can benefit a great deal from reading this thing.
Okay. Yeah. So if you pay off your debt and you needed, people will always sell you debt.
Yeah. You can get in debt again if you need to.
It's real easy.
Yeah.
And if you got out of debt, your credit rating goes up and they're more eager to do it for you.
Ugh, that's a fact. On page 35 or so on mine here, where he talks about the components of investing, he says that you need to thoroughly analyze a company and its underlying business. So you need to look at all those financials. You need to understand what it is that they do. And then 2, you need to deliberately protect yourself against serious losses. You need to seek that margin of safety. I will add to that, you need to look at your whole being when you assess those losses. What if the stocks go to zero and there's a horrible economic downturn and you can't make your mortgage payment? You'll sure wish you had that stock money to make the mortgage payment with. Screwing up the stocks could leave you homeless, possibly. You need to be real careful. You need to look at your everything that you own, I think, needs to be considered when you're looking at your portfolio. 3, you need to aspire to adequate and not extraordinary performance. Don't be swinging for the fences all the time. You need to chase a return or stock performance that will meet your needs, that's adequate. And I wrote here in the margin, so that's That's where the problem with trying to match the market comes from. Do you need the risk associated with buying the broader market if you don't need that much return? And I'm sure there are a lot of people out there that say, well, of course you need the return. And they would also say, well, you're highly diversified. You've got 500 stocks because you bought the S&P 500 index. But I don't think that's true.
So we go back to March when everything went down, or everything except Zoom stock went down.
It's true.
Well, what if you needed that money? If you need that return in order to live, well, you got screwed. And if you can't wait it out till it comes back, so that's risk. And so maybe you didn't need that. Maybe you didn't need the index fund. Maybe you needed, I guess the advice would be more bond heavy.
Well, go look at those too. Like everything's busted. The Fed's buying bonds. What do they look like?
Yeah.
Stock market sagging?
Yeah, it's weird times for sure.
Bonds haven't behaved for the last several decades in the way that Graham would have expected them to.
So what's the difference between a stock and a bond?
A stock is where you own a pro-rata piece of the assets of the company net of all of their liabilities. And it's a claim on future earnings too. So if you own stock, you're entitled to, if they make some money and declare a dividend, you're entitled to a little payout of what they made. At least that's the Hambrick definition.
Mm-hmm.
The bond's kind of the opposite of that. It's a pro-rata piece of corporate debt. These companies are so darn big, they can't go down to the first bank of what's happening now on the corner and ask for a $400 million loan to develop a new pilotless aircraft.
So when you buy a bond, you're loaning money to the company.
That's right. So instead of the company going to the bank and borrowing the money, they will sell subscriptions in the debt. They will ask you, can I borrow a little money from you? Can I borrow $50 from you? And you'll buy a bond for $50. And then they have a little coupon where they agree to pay that back to you plus some interest over a term. So they're kind of opposites.
Bonds are typically thought to be safer.
Less volatile, maybe.
Okay, so you can wait out the bond to maturity and get that money and the interest.
If the company doesn't go bankrupt.
If they don't go bankrupt.
Court protects you.
Or you could sell the bond to somebody else.
That's right.
So the bond itself, the debt becomes a tradable thing.
Yes. And bonds have credit ratings on them. You've heard of a AAA bond, or you've heard of a junk bond. If the company has bad credit, if Standard & Poor's doesn't think that they're very likely to pay that back, they'll degrade the credit rating, and the bond might be a junk bond. And so the junk bond will sell at a discount to its face value. Right? So like, let's say it's a $100 bond. People might say, boy, that's pretty risky. I think there's only a 91% chance I'll actually get paid back for that, plus the interest on it. They declare X amount of interest on the face of the thing. Well, I don't think that was a high enough interest rate that their yield that they pledged to pay. I can only give $70 for that $100 bond because I just don't know that they're going to be here. That kind of thought process would drive the price of that bond down because the yield is directly related to how much you pay for an asset.
Okay, so that's an interesting point. So the more you pay for something, the more that it's got to do for you to get value out of it.
Yeah. If you read about some prospectus on a bond and they just issued the new bond and you get to buy it directly from the issuer, let's say Schwab issues the bonds for Karl Co. I don't know. They might declare a $7 that you're going to make $7 per annum on this $100 bond. But the word on the street is that Karl Co. is just not very solvent, and they lost their biggest customer.
No, they're not. Yeah.
And so the face value of that thing says it's going to make you 7 points, but the market may not think that's enough reward. And the market may say, we're only going to pay maybe $70 for that 7 points. So that would make the yield on that $70 10%, not 7%. So that the market will tend to price in the risk. Because there's going to be some people that paid $100 for the Karl Co. bonds who are more afraid than the people that want to buy it. So they'll sell it for $70 and take that $30 bath on that thing because they're cutting their losses and going to go move to something else. This brings me to something else that Graham talks about and other people talk about. A yield should have three components. It should have your cost of capital. Like you could imagine if Hamco and Karl Co. were going to merge, we might need to borrow a little bit of money to swing the merger and get the competitive advantages that our two companies would have by being Karl Brick Industries after with the merger. So if we had to borrow that money to buy our respective stocks, I would need to get a yield that would pay me back for what it cost me to borrow the money. It's my cost of capital. Dig it?
Mm-hmm.
So our yield needs to give us cover our cost of capital. It needs to keep us at least abreast of inflation. And then the most important one, I think, is it needs to pay your risk premium. You need to get something for your trouble. We're not in this to just break even. We're not in here to just move a bunch of paper around and take a bunch of risk and just be even Steven at the end of time here. You need to get compensated for the risk. Now, how do you do that? It's hard to figure out what that risk number is, but that's why he's so concerned about this margin of safety. Because that makes sure that you will have, or that your risk premium will be protected, because you're going to pay a low price relative to the value of the intrinsic value of the stock for Graham. So you were going to ask something about bonds or something, and I went into the components of the yield.
No, I just want to clear up, because this is not something I've paid a great deal of attention to in my whole life. So, and if the dear listeners haven't either, they might have these questions. So let's say the company goes belly up, and I own like 10 shares of stock for $100 a piece, and I have loaned them 10 bonds worth at $100 a piece. But they've gone under. Mm-hmm. So what happens then?
The bondholders and the stockholders will likely be wiped out. The bankruptcy court will determine how that goes.
Does the bondholder have a claim? Or does the bankruptcy court just say you're screwed?
Well, all of the lenders will have claims on the bankrupt company. I'm talking a little bit out of my ass here. I can't remember. I don't know exactly how all this goes. Some attorney could tell us. Utilities are going to have a high priority, because a lot of times, you file bankruptcy. It might not be the death penalty kind of bankruptcy for the company where the auctioneer shows up with the gavel and sells off the bones of the company. Maybe they're going to reorganize and limp along. And if that's the case, the electric company and the phone company is going to get priority because they have to have that to continue to operate. And sometimes they'll put the lenders in forbearance and say, you're not going to get any payments. Sometimes they'll wipe out a piece of the debt, say you preferred stockholders are not going to get paid. We're wiping you out. There's a hierarchy of lenders and a hierarchy of asset owners that I don't know enough about. But if somebody files bankruptcy, lots of folks are going to get a haircut. And whether you own a bond or whether you own a stock, you're probably going to get a haircut.
Okay, so this goes to the importance of evaluating the risk. This is why you can't just trade on hoping the paper is going to go up. You have to look at the fundamentals of the company, what they're doing. Are they likely to go under, or are they likely not to? Because if you're buying a stock or a bond, it doesn't matter. If they go under, you're in trouble if you hold it too long. So that would be where the value of the company actually is priced into the market. And you do need to pay attention to this stuff. And you can't just use a chart that says IBM's going to go up. You have to realize that they were really making garbage in the 80s.
Yeah, Enron. Fraud. They didn't have hardly any of the stuff they said they had. It's fraud.
All right, so Graham says, for me, this is, page 28. It's chapter 1. We shall repeat here without apology, for the warning cannot be given too often, that the investor cannot hope for better than average results by buying new offerings or hot issues of any sort, meaning thereby those recommended for a quick profit. The contrary is almost certain to be true in the long run. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. Aggressive investors may buy other types of common stocks, but they should be done on a definitely attractive basis as established by intelligent analysis. So, if you're a defensive investor like me, I'm probably even less than a defensive investor. My bank does my investing for me. So they're minding it for me. and I hope that they do okay.
I hope they do too, Karl.
So far, so good.
Unless they're buying stuff from me, in which case, best of luck to you.
Yeah, well, I just have one of them stock heavy. I diversified by, you know how you move the sliders?
Yep.
And so one of them stock heavy and one of them's bond heavy. And I hope I'm diversified. And I don't take a haircut or is it take a haircut or get a haircut? Take a bath, get a haircut.
Well, take a bath. Yeah.
Neither of them are good for investing.
They're not good. Yeah. So he wants us to figure out what our risk tolerance is and what our approach needs to be, find out what our needs truly are, and then find a way to meet those needs without taking on undue risk. And one of the ways he wants us, there's several ways he wants us to mitigate risk. Even if you're the aggressive investor, he wants you to invest based on an objective, intelligent analysis of the assets that you're trying to buy. And even if you're an aggressive investor, he wants you to buy with the maximum margin of safety that will allow you to meet your investment goals. And he wants you to intelligently compile a portfolio with bonds and stocks in it that will help you mitigate some of your risks. Because traditionally, bonds and stocks acted in an inverse way. The stock market went down, bonds went up, stocks went down, whatever. I got that wrong. Stocks went down, bonds went up, or vice versa. That relationship has not held like it used to. And so this is me opining now. Bonds haven't yielded like they used to, and they haven't behaved quite like they used to either. Lots of stuff is super weird. In March, the stock market went to hell, and so did gold.
Mm-hmm.
Like, when does that ever happen? That's crazy.
You couldn't get silver, and it was at its lowest price ever.
Yeah.
It's weird.
What's up? Maybe there were a lot of people selling gold and silver to meet their obligations in the stock market, covering margins or something. Maybe it was flooded with gold and silver, except I called my silver guy, and I couldn't buy any. So I don't know what was going on. And then bond yields net of taxes and fees have been very, very low. And as low as CD yields are, the volatility on them is, almost zero. And the yields are real close on average to high quality bonds, actually. So that's what I do nowadays.
At 0.8%?
Yeah. So if he says 50-50, I'm probably in CDs for my what he would say was the bond half, because the bonds just aren't acting like Graham was used to seeing them act. So if the yield on an instrument is supposed to yield those three chunks, your cost of capital, your inflation, and a return on your risk, a risk premium, where the hell is that if a bond yields a point? If it's 1.5, like, where the heck is it?
Well, a savings account yields a point.
Well, arguably, though, the risk premium's zero because you're covered by the FDIC insurance and all that stuff, right? And you can't borrow money. Well, you shouldn't be borrowing money to put in your savings account. So your cost of capital is going to be there's probably no, on the savings account, there's no opportunity cost because you can just take it out of the savings account and do whatever you need to do with it. It's not tied up there. So you're just really trying to stay up with inflation with a CD or that.
Mm-hmm.
Or maybe. But your savings account, unless you got more than $250,000 in there, shouldn't be going to zero. And if it does go to zero, we really don't care about that stuff anymore. We're just looking for beans.
Right.
So he wants you to pick a stock mix, whether it's, stocks or bonds or whatever it is, based on whether you're a defensive investor or an aggressive investor. The defensive investor, he should be about 50-50 stocks and bonds. And then you rebalance a few times a year. So if your stocks go up, you'll find that your portfolio starts trending towards 60% stocks. You didn't do anything. Your stocks just went up. Well, he tells us that risk is directly proportional to the price. So if the prices go up, your stocks are riskier. They have to be. So he would say, just sell a little bit and rebalance. The stocks went up 10 points. We went from 50% of your portfolio to 60. Sell some of that, put it in bonds, and get right back to your 50-50. And you kind of auto-regulate that way. And,
Mm-hmm.
People talk about this stuff all the time, but in the 40s when he printed this, when he first did this was, I don't know, this probably wasn't something that some dude that went to Catoosa High School in Oklahoma in the 40s could have had access to. So this, a lot of this sounds like old hat now, but at the time, I don't think it was. You would have had to pay a lot of money to somebody with a great deal of experience to help you put together a value investing portfolio that was balanced in stocks and bonds.
Nowadays, you could do it just sitting,
You just slide that slider you were talking about.
Yep. Heck, I don't even think about it.
Yeah.
Actually, I slide the slider. They're supposed to rebalance it. And every now and then I get a note, we've placed a trade in your name, and I sure hope everything's all right. So far, it's okay. But, a lot of this is, if the worst comes to worse, you don't care, you've got bigger problems.
Yep. Thank you guys so much for listening to part 1 of our show about Benjamin Graham's giant book, The Intelligent Investor. We'll finish this up with part 2 next week. Meanwhile, go to your favorite podcast outlet and give us a review, please. That would be helpful to us. And send this to one of your friends. Help us spread the word about our show. Talk to you next week.